Everyone. So in this video, we're going to go over an indicator, and I'm going to use Bollinger Bands to start. I'll be doing several of these. This is going to be very simple, very basic for beginners, simple, easy to understand, and concise. What we're going to cover is Bollinger Bands, what they are, how do they work, two very simple ways to identify explosive moves before they happen, how to use them for better entries and exits, a common mistake that's pretty costly that is huge that a lot of people using them, and we're going to show you how to ride the wave of them. So before we get any further, let's just clarify exactly what we'll be looking at, because I think it's important that you understand. So a Bollinger Band, what are they? Well, it's an indicator, and it's defined by a set of trend lines plotted on two standard deviations. One of those standard deviations is positive, and the other one is negative. It's based upon the distance away from the simple moving average. Now, whatever that simple moving average is set as, the standard deviations go off of that. And we'll get into that. Now, a standard deviation, for those that aren't aware, is a number used to tell how measurements for a group are spread out from the average or mean. So, for example, you have your upper band that is calculated by a standard deviation move off of this. You have your lower band that is calculated off this line. The middle line is set at a 20-day simple moving average, and we call it the mean. Okay, and this is the guide. This mean is the guide that defines these two by a simple calculation of standard deviation. We use 20-day simple moving average, and you use a second standard deviation for the outer bands. That's how it was created. That's what I would recommend that you use. Some people may play around with that, and in your own free time, you're welcome to, and see what it does. This is the baseline. Lower band, upper band, mean. And it's all based upon where the mean is. And that's how it goes going forward. So that's what they are, and this is how they work. Now, let's just get into a couple examples of how to determine when stocks are going to have big moves. Usually you can determine this a little bit, that they're going to move ahead of time. So let's just hop right into it. Okay, so here's Tesla. Now, what this is referred to is a tightening of the band or a squeeze of the band. And it determines really important moves that are going to happen. And what I want to do is just point this out to you. So you'll see right here how tight we're getting. Right? You can see how tight the bands are getting. And that means the standard deviations to the mean line are getting tighter and tighter, and that it's setting up for a breakout. And what does it do? It expands here, see the expansion of them, and then it goes higher. This tightening of it from in here was telling you that this was setting up and breaking out for a move. You can see it again here with Tesla. See how it's wider, and then it consolidates, and then it breaks out, and you can see how thin we're getting in here. So what you're looking for is you're looking for those kinds of squeezes where that can happen. Now, you can see it even here with something as simplistic as Ford. See how you get tighter in here between the upper and lower? That is almost, you can almost tell when it's going to happen once you start to learn how to read them. And then from this base, you had this move. And conversely, it works the same way. You can see how you got tighter here on the stock, right? And then how it broke to the downside here. So that's one way using the squeeze technique, which is really what it's called, or the volatility contraction, but it's one way of really measuring it and then seeing where it lightens up. And it is helpful to utilize this tool because it does give you some clues. Another one for stocks that get extremely volatile, and one of my favorite times to actually use this indicator is when we're around stocks that maybe have gone down too far too fast. And what they're called is I call them out and ins. And it's when they move way too fast in a short period of time. So I'm going to give you an example. When you pop out of the lower band and then you pop back in, that can be defined as a trigger move. That trigger move usually means we're going to revert to the mean line. So in other words, you broke out here and then you reverted to this mean line. You broke out here and you reverted to this mean line. And you can see what I'm getting at here. We're here right now and we're probably heading for this. So this is telling you that we've gone too far too fast. It's not telling you that the direction's changing. It's just telling you you've gone too far too fast. And you can even see that on the upper side when you're this far out, how it rejects. So it's really important, and this is if you were looking to, if you were going to put a short on and you're looking at this and you see it pop out, it's another data point for you to use. So that's how to identify it with, an out and in move, as I refer to them. And you can set these levels differently, but I would really recommend just staying with the second standard deviation. And I'm going to show you one that's just absolutely insane right after this one. But let's just walk through this for a moment. You break down here and you try to go up, but then we break down again and we go right to the 20 day, which is the mean. You hit again and you're setting up for the 20 day. So you can see how it constantly happens. So that's why people use it as a gauge. You can see here where there's really no support here, but yet it bounces because it's gone too fast. And you can see within a day, we almost get back to there. Here it undercuts and there's really no support here. And then it bounces right back to it. So this is really important and it's a very easy way to get in front of stocks. So both those ways, the squeeze is what you want to look for, and these out and ins, which is usually a really fast, volatile move, and then you'll revert to the mean. Now, this is just came out, Discovery, and you can see how far we are out of the mean, or out of the lower band rather, right? You need to get back in the lower band before this is triggered. Now, just why this is important is to understand that these extreme moves, they can always get worse. This is one indicator and tool. But what I want to see is as this gets wider, I want to see this come up, get in there. Then when this gets in there, that would trigger to me, especially in a move of this magnitude, that it could get to the 66 level, which would be the mean. And that's what we would look for. So that's how you would use them to identify certain moves that have the potential to rocket. Now, to better time them and your entries and your exits, very simply, here's your upper band, here's your lower band, and you can see even here's one of those contractions we just talked about. You roll down and you're at your lower band. When you flip this band up, so you flip the mean up, that's where you can enter. Now let's say that you miss that entry and you're watching this go on the whole time and going, where do I buy it? You can try to enter along the median line. And if you look, it provided really good opportunities, constantly holding it. And then at the same point, if you were thinking about being on the other side of it, when it breaks, you could short it, right? You can see how this can work. And you can see it up here as well where we hit, reject, come back down to the line. Here's crowd, a great example of what we just talked about. We broke through and then we bounced right back to the median. Now we're back down here again. So it's very simple once you start doing it. I'd recommend that you play around with it yourself on a couple different stocks. Just keep doing it over and over again and you'll start understanding it. So you can see how you test here and then bounce, test and bounce, test and bounce. And these are all great places that if you wanted to sell, let's say you were in this, you sell here, you don't sell here. So that's one way to look at the trade. But if you look at this trigger and you see how you can overlay these together, right? How you have this contraction comes down, you have the expansion, then you flip the line, and then as soon as you flip the line, what happens? You just run the whole time, and as it's running, every single time it's hitting this line, it's respecting it, and it's going higher. So these are all could be buy points. That's one way to use the Bollinger Bands and use the mean to enter. And I think it's important. Now, one of the largest, costliest mistakes I see with this is that people make assumptions. And the one assumption that people make, and please don't make this assumption, is that when you come out here and you pop over, that it's an automatic sell. If you look at really performing stocks, this was from $7 all the way up to 20. And all it did was ride the second Bollinger Band up. So do not use these to get out of winning positions. Follow the trend. And another example to the downside. So just because I break down and I'm hitting the lower end over and over again does not mean you stay in the trade. This went from 31 all the way down to 2, and it kept hitting this the entire time. So that's a really costly mistake that I see that people make when they first start to use these, saying, oh, I don't need to sell because it hit this level. That's not how you use them. So let's get into just how you would use these to ride a wave. In other words, how you're going to follow a trend with these. And here's a great example of one. So you would have this contraction up here. And essentially what you're doing is saying that, let's just say for the sake of argument, you wanted to be short this. You could wait, right, for this to happen and say, I'm going to stay in it until I close above the mean. And you're triggered here, and you just stay in this until it closes above the mean. And it doesn't close above the mean yet. So you would still be in this trade the whole time. It's a way of taking the guessing out of when to close the trade. Very similar to here. You could be in the trade and buy, and as you see it respecting it, and then the moment it closes below it, whether you got here or here, you're out of the trade. Either way. And either way, it's a profitable trade, and you're not playing around with this if you were long here. So that's one way to ride the wave, and it is effective to understand this and to utilize this. I'll give you one more example. So here's GLD, and this is about as clean as you can get as an example. You can see clearly the mean. Now look what happens when you break. And you keep hitting it and hitting it. Now you break down here, like we talked about before, and you get those in and out trades where then if you break here, you might bounce here, and you can see how many times it's done that. But you can ride this line the whole way down, as we talked about that costly move. But if you were to be in a short position based upon this and stayed in it, you may be getting out now because it crossed here. So that's it in a nutshell. I hope you found it helpful. This is one of many tools. If you did, please subscribe, because I'm going to start showing people how to use these in a very simple and effective way, the majority of indicators that are out there.